Rents in America just posted their steepest drop in over 15 years, and multifamily mortgage delinquencies at Fannie and Freddie have surged to their highest level since the last housing bust. But here's what nobody's talking about. While small landlords are going broke, Wall Street firms are quietly positioning for the biggest real estate buying spree in 2008. I'm talking about a $50 billion opportunity that's flying completely under the radar. In the next 10 minutes, I'm going to show you exactly how this rent crash is triggering a wave of landlord defaults, why Trump's policy to ban Wall Street from buying homes is accidentally making this worse, and most importantly, what this means for you, whether you're a renter looking for deals, a homeowner worried about your property value, or an investor trying to figure out if this is your buying opportunity. Because what's happening right now in markets like Austin, Phoenix, and Dallas is just the beginning of the biggest real estate shakeup since 2008. We're witnessing the biggest rental market collapse in 15 years, and it's happening in real time. The national median rent ended 2025 at $1,356. That's down 0.8% in December alone. We're talking about 5 straight months of declines, leaving us with negative 1.3% year-over-year growth. But Austin, Texas is the poster child for this disaster. Rents there have collapsed more than 20% from their 2022 peak of $1,726. Think about that. We're talking about Austin going from boom to bust faster than any major metro in America. And it's not just Austin. According to CoStar and Apartment List, we're seeing double-digit rent crashes across the Sun Belt. Fort Myers down 18%, Colorado Springs down 15%, Phoenix down 14%. Sarasota, Florida down 14%. These are markets that were red hot just 3 years ago. What's driving this? 3 massive factors that apartment developers completely missed. First, oversupply. During the pandemic, builders went absolutely insane. We hit a peak of 2 million homes under construction. Even now, we still have 1.3 to 1.4 million units in the pipeline coming online in 2026. Second, immigration has fallen off a cliff. According to John Burns' research, 100%, let me repeat that, 100% of renter demand from 2022 to 24 was due to immigration. We're looking at the lowest immigration levels in 4 to 5 decades, possibly going negative in 2025. Third, job market weakness in these Sunbelt boom towns. When tech companies stopped hiring and construction slowed, all those people who moved for opportunity, they're either leaving or can't afford these inflated rents anymore. Real quick, if this market intel is helping you make better decisions, hit the notification bell. We drop new housing data every week, and the viewers who catch it first get the best opportunities. The bell ensures you see everything immediately, not days later when the market's already moved. Now, here's where it gets ugly for landlords. Many of these apartment deals were underwritten assuming 5 to 10% annual rent growth and ultra-cheap debt from 2019 to 21. They built their entire business model on rents going up forever. Now look at the numbers. Fannie Mae's seriously delinquent multifamily rate jumped to 0.75% in November 2025, up from just 0.24% in December 2022. That's more than tripling in 3 years. Freddie Mac's rate climbed to 0.48%, also the highest in decades. Now, 0.75% might sound small, but context matters. This is the highest level since the post-housing bust years of 2010 to 2011. We're talking about post-crisis peaks being exceeded right now in 2026. Let me walk you through the death spiral. A landlord buys an apartment building in 2021, assuming $2,000 average rent. They get a loan based on that cash flow. Now, rents drop to $1,600. That's a 20% hit, but their expenses went up. Property taxes, insurance, maintenance, all increased with inflation. Meanwhile, their cheap 3% mortgage from 2021 is coming due for refinancing in 25, 26, or 27. Now they need to refinance at 6 or 7% rates. The math ain't mathin'. Their debt service coverage ratio, that's the bank's key metric, falls below 1.25. The lenders panic. This is why RealPage reported that apartment demand flipped negative in Q4 2025, minus 40,000 on demand, plus 89,000 on supply. When you have failing demand and rising supply, you get deeper rent cuts, which accelerates the default cycle. Here's the part that should make every American angry. While mom and pop landlords are getting crushed, institutional capital is getting ready for the biggest feeding frenzy since 2008. Companies like Blackstone, Starwood Capital, and other private equity giants have been sitting on mountains of cash, waiting for exactly this moment. They know that distressed sellers will accept 50 to 60 cents on the dollar. But here's the twist nobody saw coming. Trump's executive order to ban institutional investors from buying single-family homes isn't stopping Wall Street. It's redirecting them. If they can't buy houses, where do you think all that capital goes? Straight into multifamily and commercial real estate. This policy is accidentally creating a massive opportunity for institutional buyers in the apartment space. No formal ban exists on multifamily purchases, so Wall Street is doubling down on distressed apartment deals. The real play isn't even buying buildings directly. Smart money is buying the distressed debt from lenders who don't want to own apartment complexes. When a regional bank has a $50 million apartment loan that's about to go bad, they'll sell that note to Blackstone for $25 million just to get it off their books. Then Blackstone forecloses, takes the property, invests $5 million in renovations, and waits for the market to recover. In 3 to 5 years, they'll sell or refinance at full market value. It's the same playbook they used after 2008, when they made billions buying distressed homes. According to industry sources we've talked to, we're looking at potentially $50 billion in distressed multifamily assets coming to market over the next 24 months. That's apartment buildings, office conversions, mixed-use projects, all available at massive discounts. Let's be clear about who gets crushed in this cycle. First, over-leveraged landlords who bought at peak pricing in 2021 and 22 with floating rate debt. These are the apartment syndicators who raised money from regular investors, promising 15 to 20% returns. They're getting wiped out. Second, regional and community banks that made these loans. They're stuck with badly underwritten multifamily debt that's underwater. Some of these banks will fail. Others will be forced to sell loans at huge losses. Third, individual investors who bought into these syndications. They're about to learn that passive real estate investing isn't as safe as they thought. Many will lose their entire investment. But there are winners too. Cash-rich institutions with patient capital are about to make generational wealth. They can buy assets at 50 cents on the dollar and wait for recovery. Smart local investors with dry powder and conservative underwriting will find deals, but you need all cash or very conservative loan-to-value ratios to compete with institutional buyers. And renters? This is actually great news for renters in oversupplied markets. In Dallas, you can find one-bedroom apartments in Uptown for under $900 a month. 3 years ago, that same unit was $1,400. Austin renters are seeing even bigger savings, with vacancy near 10% and landlords offering 8 weeks free rent. The effective rents are down 25 to 30% from peak. That's real affordability returning to the market. For renters in oversupplied Sunbelt markets, this is your moment. Negotiate aggressively. Look for concessions like free months, waived deposits, or included parking. Landlords are desperate to fill units. Track 3 key metrics before signing any lease: vacancy rates in your target area, construction pipeline coming online, and rent concessions being offered. If vacancy is above 8% and construction is still heavy, rents will keep falling. For homeowners, don't panic. This is primarily an apartment sector recession, not a repeat of 2008. Single-family home supply is still constrained in most markets. Your home value might plateau or grow slower, but we're not looking at 2008-style crashes in home prices. For small investors, be extremely careful. Avoid peak-priced syndications and any deal that requires 2021-level rent assumptions. Focus on markets where supply is slowing, not accelerating. Cash is king right now. If you're thinking about buying investment property, wait 6 to 12 months. The best deals are coming as more landlords hit refinancing walls in late 2026 and early 2027. Let the institutional buyers compete for the first wave of distressed assets. Most importantly, understand this isn't just about real estate. The apartment crash could spread to retail, restaurants, and services in these Sunbelt markets. When landlords cut rents by 20%, consumer spending in those areas drops too. The 2026 rent crash is creating the biggest real estate opportunity since 2008, but most Americans don't even know it's happening. While small landlords get crushed, Wall Street is positioning for a $50 billion buying spree that will consolidate even more rental housing under institutional ownership. If you found this breakdown valuable, subscribe and hit that notification bell for the latest market updates. In 2026, timing is everything. Let us know in the comments, are you seeing rent cuts in your market? And do you think this apartment crash will spread to home prices? We read every comment and respond to as many as possible. Thanks for watching, and we'll see you in the next video where we'll dive deeper into which specific markets are seeing the biggest institutional buying activity. See you then.